Okay, this old style syllabus paper for Unit 2 focuses on the balance of payments. So the balance of payments is a kind of an account that shows all the imports and exports involved within the UK economy. So it shows the flow of money going into and out of the economy. And it's one of the macroeconomic objectives that we have a balance in the balance of payments, that we have an equilibrium. So we start off, and you can see here, real GDP growth. So GDP has been minus figures here. This is bad. We've then got an example of the balance of payments. Now, the balance of payments is a number of different accounts. But if you look at the syllabus, it specifically wants you to know about the current account. That's like the main account in the balance of payments, and it's split up into three sections. We've got trade in goods and services, so that's all the goods and services bought and sold, imported and exported. We've got incomes coming in and out of the economy, so money flowing in and money flowing out. And we've got transfers, so that's the total current balance. You can see it's a minus. If the balance is a minus, that means we've got more money going out than we have coming in. And then it tells us a little bit about the recent recession that had happened in 2008, 2009, and what effects that's had on people. So let's start here. Using the data in Figure 1, explain what is meant by a recession. So I've got to use Figure 1. So I can use the information here. A recession is half a year or more of negative GDP growth. So it's when GDP has actually shrunk for at least half a year or 2 quarters. So a quarter of a year. So 2 quarters of a year or half a year of negative GDP growth. Now I've got to use the table, I've got to use the figures because it asks me to. So I could say, for example, between the end of 2007, or I could say, I suppose that is there 2008. So I could say, for example, from the second quarter of 2008 until the end of 2009, there was a recession because there was negative GDP growth. So I'm using the table there. I could say there was not a recession at the end of 2010 because that was only 1 quarter of negative growth. It has to be at least 2 quarters or half a year. So that sorts that one out. With reference to Figure 1, explain why economists might consider that a negative output gap existed in 2008. Now, so let's have a look. So 2008, the economy was shrinking. What's a negative output gap? Well, it's when the economy, there is a difference between how much we're currently producing within the economy and the maximum amount that could be produced. So if you have a negative output gap, it means that you're currently producing less than what is estimated you could be producing within the economy. Now, how would I show that on a graph? Well, there's actually a number of different ways you could do that, and the best way for me to illustrate it is to show you the mark scheme, because in the mark scheme they give you various different examples. So you could draw the economic cycle, which you see here, and if you look here, during a recession, 2008, we would be down at the bottom. We'd be in this trough because it's negative growth. Now, when you're drawing a business cycle, the economic cycle, you can draw a straight line like this. This is kind of the maximum that you could be producing. So you see the difference between the maximum and where you currently are would be called the output gap. That's one way of doing it. There's another way as well. They've drawn aggregate supply and demand, and you could say that's the maximum supply that you could have. But if you're there, then look at that gap. That's the gap between supply and the maximum supply. That's another way of doing it. The way I would probably do it is I draw a PPF. This is the maximum that the economy could be producing, and this is where you currently are, anywhere down here. So the difference between being here and on the line is the output gap. Now taking it back here, 3. With reference to extract 1, assess 2 factors likely to affect the level of aggregate demand. Well, any 2 factors? I've just got to look for things within the economy. Right, what's going to affect aggregate demand? Household debt. I could use that one. Household debt. So, consumers having more debt means they'll have to make more repayments. So therefore they'll have less disposable income because they're paying more money on their debts, which means AD will go down because consumption will go down. You could say, what else? Interest rates, right? So 0.5 interest rates means that that should encourage businesses to invest more, and therefore that would push up aggregate demand. However, it has actually said here that even though it was low, hasn't actually happened at all. So kind of giving different examples here. B. With reference to figure 2, explain why the UK current balance was a net withdrawal, right? So what does it mean if we have a net withdrawal? That means that more money was flowing out of the economy than it was flowing into the economy. Why has this happened? Because if we look here, using the figures, trade in goods is minus 97.8 billion. That means if you look at the trade, anything on your current account, if it's a minus, that means overall more was flowing out than was coming in. So you can see here, services, we were actually exporting more services than we were importing. But when it comes to physical goods, we import way more than we export. So that could lead to then a deficit because we export much less physical goods than we import. That creates a very large gap here, a minus, a deficit. Also, current transfers. More money is essentially flowing out of the economy than it is flowing in. So that is why we have a deficit. So I'd use these numbers to illustrate my answer. When they ask you to use the figure, they want you to actually use the numbers as well. Explain 2 possible problems for the UK economy of its persistent and increasing current account deficit. So why is it bad if you have a persistent account deficit? Right. Firstly, if you have an account deficit, it means that on average you are importing a lot more than you're exporting. Therefore, businesses in the long term, UK businesses, will find that they have less sales abroad. So this is lowering their sales because we're importing more from other countries. Therefore, UK businesses are missing out because we're not buying from the UK, we're buying from abroad. So therefore, this will have a negative effect on UK businesses. Supply within the UK will go down, and this could cause unemployment to occur. So that's one point. If we're not buying from the UK, this could cause UK unemployment to go up. Also, a similar but slightly different effect is that because UK businesses will be supplying less, that's not just that unemployment will go up, but also that could affect growth because less supply means less products being produced, which means GDP could go down, and this could cause a recession. So it could cause a recession, it could increase unemployment as well. Those are the 2 kind of factors that I would stick to. Next question. Examine 2 possible causes of the largest ever recorded trade in goods deficit. Right. Why is the value of the amount we are importing the largest ever in 2010? What was it about 2010 that meant that we were importing more than ever before? Well, there's a few ways you could look at this. One, it could be that although we're not necessarily importing more in terms of units or volume, maybe the value of what we're importing has gone up. Why would that be? Well, you could argue maybe the price of oil, which is something that we import a lot of, has gone up in other countries around the world, which means that costs us more to import the products, which means that's why the value has gone up. It's not that we're actually importing more units, It's that they cost more than they used to, causing us to have a bigger deficit. You could also use a similar point with not just oil, but we also import a lot of food as well. You could say maybe the world price of food in general has gone up, which has caused the deficit to get even larger. Another argument you could make is that perhaps businesses within the UK, we don't have substitutes here for products that we import from abroad. So maybe the reason why we import so much is because we don't have enough UK manufacturers that could provide a substitute product. You could also discuss the idea that perhaps we simply don't have enough UK manufacturers in general. The idea could be that because we are a country that likes to import, business confidence has gone down. So UK businesses don't feel confident enough to spend money on investment to grow so that they can provide us with more products, because they know that consumers often prefer to import from abroad. Could also be another point. You could say, why are we importing so much? Perhaps the pound has got stronger compared to other currencies, especially currencies of countries where we import from. So if our pound is stronger, therefore we will be buying more, and so we are encouraged to import more from abroad. You could actually also use it the other way around. You could say, what if the pound got weaker? We'd still need to import, but it would cost more to import. So that could be another reason why the deficit's gone up. It's not that we're importing more, it's because the pound's got weaker, and so therefore we have to still buy the same amount, but it's got more expensive. So those are a lot of different answers you could go at that. There's many different reasons. Price changes, currency changes, lack of UK businesses, all of those are very relevant answers. And then finally, evaluate the benefits of economic growth for the UK. Now, a very wide question. UK growth benefits consumers because as there's more growth, more is being produced, therefore businesses will need more workers, so that it decreases unemployment. Economic growth is good for the government because as the economy grows, consumers generally have more disposable income, they'll be spending more tax revenue for the government, and less spending on benefits because there'll be less unemployment. So you could say it helps the government to meet their target of having a balanced budget. It also helps the government meet their target of economic growth and their target of low unemployment. However, I'm just chucking in an evaluation point. An increase in aggregate demand because consumers have more disposable income could lead to demand pull inflation. And this will have a negative effect because it makes everything more expensive. And it could, in theory, cause unemployment at some point. It also means the government then doesn't meet its target of trying to have low and stable inflation at 2%. Now the benefit is for businesses. They will find that as the economy grows and aggregate demand goes up, therefore they will be supplying more, they'll be making more money as well. So essentially there is a huge amount of positives for economic growth, but then negatives. It also has a negative effect on the environment. As we're growing, as we're supplying more, therefore that has a negative effect on the environment because factories are pumping out more of that pollutant, which is clearly a very negative thing. There's many different points you could give, and that is the paper on the current account.